So once again, everybody welcome. Let's go ahead. We're going to start from where we stopped in the evening. And I think we stopped from 6 point something. 6 point something, I'm not sure. Just like I said before, this chapter, please just grab what you can grab in this chapter. Believe me, questions comes from this chapter. Yes. Because this is the principle of life insurance. Being an agent, this is exactly what you will do. So questions basically come from here, from this chapter, because it's telling you everything you will do as an agent, all the things you will do to your client is what this chapter is talking about. So it's good you pay attention to it. Any of the things that we miss or anything you do not get it clear, I'm not saying that you cram, not cramming. Just want you to interpret it and explain it to your own word. So any of the things you cannot understand, your own personal explanation to it will recall us back so we can say it and say it again, because there's no need to rush through it and nobody understood. It doesn't make sense. I believe that if we finish one, let that one be one that we have finished it, instead of finishing 100 and nothing is, I know, that's my own belief. That is the way I want it to be. So we are now going to talk about premium calculation. Everybody have known how premium come to be. Premium is based on what? Your risk level, your age, your sex, your medical condition. So all those things now bring together will now be on what determines your risk level. Of course, we have known 3 types of risk classification. We talked about preferred, we talked about standard and substandard. We said our preferred is 15%. The premium is 15% lower than the standard. We said the standard is normal premium, and the substandard is about 50% lower than, higher than the standard. That will show you what substandard is. That will show you that if somebody is classified as substandard, that person is going to pay more. Now, let's assume somebody is classified as substandard, and more especially that person is included again old age in terms of age. You now add age, add male, and now add the substandard classification. You know what it will be? You see that person, the policy will be so high, the premium will be so high. Classification first, substandard. Based on this person is male, based on the age of that person, you can see how high the premium will be. Then compare it with the substandard based on age and female. They're not going to be the same. They're not going to be the same. So more especially now tells us that the earlier the better. There is no need to waste time in having a policy. Do everybody need a policy? Believe me, everybody need a policy. Anybody who tells you otherwise is just lying to himself, probably because he does not want to invest on it, or probably he doesn't have money to do that. But believe me, everybody need a policy. You see how they force us that we must get policy on our mortgages, that we must get insurance on our insurance on our on our cars, on our homes, on even on our phones. That is how it's supposed to be, that you must. It's supposed not be optional. Just like what Obama did at Obamacare, that if you don't have policy, I think you'll be fine, something like that. That's how it's supposed to be on life insurance. All right, let's now come back to our community. Our community, what we're doing in our community today, the other communities are not doing it. In the sense that if anything happen, you will call their community to come and bring money. Other communities are not doing it. I hope you guys know. Other communities are not doing what we're doing today. And it has now become a big problem that everybody wants a piece of the cake. In fact, For the past 6 months, I've not gone to our town meeting. And unfortunately for me, on Sunday, I went. So when we get there, our community, what we do is this. If somebody, a child finish high school, want to enter into college, he must be given $250. That's what we do. That's for just to buy, we say use it to buy your shoe for your school. We say buying shoe for them. If you finish high school, you want to go to college, we buy shoe for you by giving you $250. Everybody. So somebody has been given, why I'm recounting this story is that to tell you the entitlement mentality we have as far as this contribution we make whenever anybody dies. It has become an entitlement. So somebody was given $250 for graduation. I mean, for going into college. Now, this person went into college, called us for graduation. Then in the Constitution, there is this clause that said, if somebody invites us for graduation, we can give a token of probably from from $100 to $150 if somebody invites us. Then we're in Dallas. So this person is doing graduation in Arkansas. He invited us. So our people are saying, in fact, everybody was just like crazy. Definitely nobody will drive from here to Arkansas. From Dallas to Arkansas is about 2.5 hours. I mean, 4.5 hours to 5 hours. Now, you see that, definitely nobody will come. Now, you call everybody asking for benefits. So people were so mad. So why I'm giving you this story is just to tell us the entitlement mentality we have already gotten. It's just like you sending money to Nigeria. You send money to Nigeria always. At a point, people will see it as an entitlement, as a right. One of my friends, two of his brothers that is in Nigeria, called him one day, was telling him that he's supposed to place them in a salary. He's supposed to place them in a salary. So that's to show you the mentality we have gotten. So most people, if you're telling them about this insurance, they will see it as that you are beating backwards. But the only thing that can remove us from that mentality today is life insurance. That if person is dying, already you know that person will be taken care of. If you guys want to carry the person transport the person from here to heaven with car or with plane from here to heaven, there is money to transport the person to heaven. If the person wants to transfer anywhere in the world, because the money that person will get, if you have a policy, will be enough to transport the person anywhere they want, even in the heaven itself. They want to use plane to go to heaven. They can't because the money is there. So whether somebody contributes or not contributing will not be the issue again. In essence, the essence of life insurance is needed everywhere. And the affordability depends on the premium and the amount you decide to buy. But however, instead of you not getting because of no money, get as little as you can. Yes, get as little as you can. Get as little as you can. Instead of you to contribute, there's this contribution people are doing every week or every 2 weeks, they contribute 1,000. Every week, every 2 weeks, they contribute 1,000. Instead of you to do that, go and get life insurance, even if it's $100,000. You know the reason? As far as the cash value is yielding some profit for you, then that contribution, everybody every week contribute 1,000, every week contribute 1,000. After this person carry, the other week, the another person carry. That is complete waste of your money and waste of everything. Easy to buy life insurance. 50,000 life insurance can be yielding you cash value. So these are the things all of us here, this will be our job. Because for the fact you are here, your purpose of being here is to become an educator to our community. It's not about, honestly, it's not about writing policy. Let me tell you guys the truth. It's not it's no longer about you writing policy. It's about you teaching our people the fundamentals of finance. What it takes to manage the little you are making. That is the main reason why everybody is here. The policy you're writing, and the money that comes out of it, it becomes a bonus. It's not about writing policy. It's not about insurance. It's about having a financial mindset to be able to manage what you have, a little bit you have. So that's why we're here. And what can take you to that is the premium. How much premium do I gonna pay? Can I be able to afford it or can I not afford it? So those premiums are dependent on those factors I just mentioned. Factors like what risk classification you are in, what kind of age, that risk classification will be based on the age, will be based on your medical condition, will be based on your sex, will be based on your social life, will be based even how you pay people. Are you such person that pays good? If you owe somebody, you pay without getting a penalty. So those are the factors that determines our premium. More especially is about your health condition. Health condition is about your health condition. So you will learn about the fundamental formula for health insurance premium morbidity. Of course, for health insurance, the mathematical way of getting the premium is what? Morbidity minus interest plus expenses. Morbidity minus interest plus expenses. That is the formula for what? Premium. Premium, I don't think anybody who has been going to exam have seen this form calculation. They have not been there, but for benefit of that and just to keep it for exam purposes, in case, but I'm not sure, they will ask this kind of thing. So in case if they ask, the formula for health insurance premium, not life insurance. The formula for health insurance premium is what? Morbidity minus interest plus expenses. So that will give you the premium you will pay. And of course, all of us know what is morbidity. The interest, of course, expenses, So that will give you the formula on what is the premium is. However, most insurance companies have a table where they pick your premium.
Excuse me, sir. Sorry for cutting you short. Please, can you rewind that again once more? I'm so sorry for.
All right. So what I said is that
The
the
formula
formula for calculating health insurance premium,
Okay.
health insurance premium is morbidity minus interest plus expenses.
Okay.
That
All
is
right.
it here. See where I highlight? That's where I highlight.
Thank
Mobility
you.
minus interest plus expense. That is the formula for calculating
Okay, thank you,
health
sir.
insurance, all right, premium. So this formula is based on these elements such as what? The benefit period, elimination period, and claims experience. Remember, all of us should know what is benefit period and the elimination period. I think all of us should know what it is. Whenever I see the elimination period, all this period, I always beckon on everybody to please make sure you document it somewhere so that before you go to the exam, you can be able to go through it, because there's always a lot of periods and a lot of confusion on it. So the more you go through it, the better for you. And if it help you to understand it, that will not bring confusion to you when you go to exam hall. So as an insurance professional, remember, if you pass the exam, you now become an insurance professional. We call anybody who passes his license now become a licensed insurance professional. Licensed insurance professional. That's why if you pass your license, you get your license. You become licensed professional, a licensed insurance professional, or licensed financial professional. Sorry, licensed financial professional, PFP. So immediately you pass the exam, that's what they'll be addressing you as, yes. So the premium is what we're talking about. The premium is now based on what? All things put together from the risk, all the risk and everything that makes up the risk we give you the premium. And to calculate the premium, we say is morbidity minus interest plus expenses. That will give you what? The premium for each client. So as an insurance professional, client will frequently ask you why their premium are set at certain levels. And the concept of this section will equip you on have to provide a clear and accurate explanation. Of course, if you remember, even when you are writing a policy, that question come to you. You ask the agent, but why my premium is so high like this? Because you don't know. So as every other person who has not been where you are today does not know why the premium is like that. So if somebody asks you that question, at least you can be able to tell the person now, presently, as we are here now, you can be able to tell the person why the premium is like that, why it's so low or why it's so expensive. At least, let's assume the thing come to your exam. Can anybody tell us why the premium is so high or why the premium is so low? That's on your own word. Don't copy anything, just on your own word. Can somebody say something about that? That is others we follow, others we copy from it. And can anybody make an explanation based on what we have discussed both in the morning and now? Why the premium is so high?
The premium can be high based on your age, your health, the type of job you do,
good,
or the sports you play, something like that.
And the social life,
social life, that's the type of life you live.
Sex.
And their sex, good. So all those things are what can make your premium go high. Based on all those things now she mentioned, all of them will come up to will put you in a particular risk classification. And that risk classification will now shoot you up to where you will be. Remember, we said the preferred is 50% lower than what? The standard. The standard is the normal premium. And the substandard is 50% above what? Standard. So that will tell you that if somebody is classified as substandard, that person is on the going to pay a lot of premium. So another thing we should know is premium mode. When they're talking about premium, they are telling you what is the frequency of payment. Premium mode, the frequency of payment is called premium mode. Most times, definitely, you see this premium mode, you will see it on the exam. They will ask this in one way or the other in the exam. Premium mode means that the frequency of premium. How is the premium being paid? Is this premium being paid monthly? Or is it being paid quarterly? Or is it being paid semi-annually? Or is it being paid weekly? That is the premium mode. How is it being paid? What is the frequency? Some policy you may decide to pay the premium every week. You may decide to pay the premium every 2 weeks. You may decide to pay every month. You may decide to pay quarterly. You may decide to pay semi-annually, which is every 6 months. And you may decide to pay annually. But remember, let's go extra a little bit, talk about life insurance in terms of cash value life insurance. Remember, the premium mode determine how your cash value build up, and the time and the period or the year or the month or days that you can now say you want to take out some money out of your policy. So if you have a policy and you are paying annually, it gives your policy the benefit of that to grow easily, your cash value to grow easily. If you are paying your policy monthly, you are barely keeping that policy alive. Yes. Just like if you're paying credit card. If you're paying credit card today, the credit card company will always tell you, the minimum, you can, it's good. We just give you the minimum, doing as if they're doing good for you, thing for you. Oh, just pay the minimum, $30. You can always pay $30, pay the minimum $30. Do not agree. Oh. $30 is the minimum. But if you continue to pay that $30 as a minimum, the one principal remaining will be compounded for you. So if they say $30 is the minimum, pay $40 or $50. Yes, don't pay that. If they say $30 is the minimum, and they will, oh my God, these people know how to do marketing. If they tell you to pay $30, the way they'll be promoting that $30 as if that is the best thing that can happen to you. Yes. I followed one friend come to my office that was on Thursday. He want to buy a new car. I said, please, I should help him to go. He has not gone there before. He want to buy the dealer. He want to go and buy a new car. He has not gone there before. He said, please, I should help him. So he waited in my office until I have a time and now follows him to where he's going to buy. That was yesterday or therefore. No, that should be Thursday last week. We now enter into dealership. So when we go there, the car was $42,000, which is Toyota Tundra. It's a new one. So they told him that what he'll be paying is the minimum is paid with $750. So I said, is that the minimum? I said, yes. I said, all right. You don't need to argue. So immediately they said that, I said, no problem. Say, of course, it's a good deal to pay $750 every month. It's a good deal because he put down $20,000 and has a very good credit. So what remains is $22,000. And by the time that $22,000 is spread, he will end up paying $60-something to $70,000. So when they say $750, I said, all right, that's good. So when I come out, the guy brought the car, we went to my office. We have to log in. I have to help him schedule his payment. I told boy, you're not going to pay $750. You're going to pay $1,200 every month. You can afford that. The guy said, what? I say, yes, that's what you pay. If you pay $700, so if you pay $750, these people, you're going to end up paying them around $70,000 to $80,000. But pay $1,200, which means you are paying almost double, more than half of what they told you to pay. Which means you are paying $750, you're now paying $1,200. You're almost getting close to half. So, which is good. And he scheduled the payment to be like that. He scheduled the payment mode he scheduled is monthly. So every month they will withdraw from his account $1,200 instead of $750. So you can see that how much is he putting on the principal? He's putting on the principal close to $400 or almost $500. That's what he's putting on the principal. So that is the understanding of how to pay all this. You have a home, they told you when you close your home, they say pay for is $1,000. Make sure you add something that goes directly to the principal. And if you add it to your home, don't just add it and say you are paying extra. No. You have to call them that this one is going to the principal. If you are paying $2,000 in your mortgage, make sure you add even $1 to that $2,000. And when you add that $1, call them and tell them that, look, the extra $1 I put on this money is going directly to my principal. If you do not call them, what they will do, they'll be collecting that $1 you are putting in. They will not direct it to the principal. They will be crediting it to your account. In that way, it's not making any effort. It's not making any impact on your principal. These people are playing us game, and believe me, we are catching up. So by the time we understand all this, we're going to close up loopholes of paying things unnecessarily, paying extra money. We are feeding them. That's the truth, whether you like it or not. Some people may not say it's lie, but that is the basic truth. So by the time you understand the circumstances behind all these things we are doing today, we call it life insurance. Yes, it's life insurance, but there's some more behind that. It's not only about you writing policy. It's not only about life insurance, but you getting educated wisely. I mean, financially educated, which is more than it's more than the job we are doing, because you go to work. Some nurses work 12 hours. They work 12 hours from Monday to Friday. That money they work, you see, half of the money is not coming to them. So what's the basis? So please, this is needful. So the premium mode is the frequency of payment. How do you pay their premium? That is the premium mode. So what does the mode make? Mode help us to make it more convenient for the policy owner to pay premium. When you put it on premium mode, it helps you to pay the premium. But but it will also increase administrative costs and delay the receipt of funds for investment. That is one other thing I want people to understand. For instance, if you are paying premium mode, you are paying every month. Yes, it's what is easy for you, but remember, the administrative fees is high. You pay today on this month, and next month you pay again. The same administrative fee charge you to this month is really the same administrative fee that will be charged you next month. You now decide that you are paying quarterly, then which means every 4 months. Now, the administrative fees they're going to charge you on quarterly will be based on what? 1 month of administrative fee, because the same thing. You now decide to pay annually. Is 1 month administrative fee they're going to charge you, because they're doing the same job. That job they will do every month charging you, they will do it once and charge you once. So if you add administrative fees to whatever you are paying, you see that you are paying more. That is why if you buy auto insurance today, if you are paying monthly, you are paying more. If you are paying every 6 months, you are paying less. If you now pay every year, good, you are paying perfectly, you are paying less and lesser. So if you have auto insurance today, you are paying every month, they are charging you administrative fees every month, and that is why it will be high. If you decide to pay every 6 months, you have reduced it. So that administrative, they will be charging you every month, they charge it only once, because they're going to do the administrative work only once. If you decide to say, I'm going to pay monthly, then the administrative fee will be applied every month. You pay more.
I have a question.
Now go ahead.
So now I have a universal life insurance for me and my kids and my family. So
Yep.
can I call them now and tell them that I'll be paying every 6 months?
Yes, of course. Yes.
Okay.
You can call them that, look, you want to pay by semi-annually. You want to pay annually. That you see that you are paying less and making much impact on your policy, because the cash value build up will be increased. Okay. If you are paying monthly, you are, just like I said before, you are barely keeping the policy alive.
Yeah.
And there's one other thing that people used to trick people. That is why some people ignorantly cancel their policy. Now, when you are writing policy, I said it before, you have to have something in mind. What is the need of this policy to me and my family? You have to have that in mind. If your mind is to accumulate wealth, then what happens? You have to design in a way that you do that. If your mind is for protection, you have to design it to do that. Let me tell you. You see, we have been in this business for more than close to 5 years now, or more than 5 years. What we find out is that our people like cheap thing. Our people so much like cheap, and we pay for it in future. Let me use I'm going to use Ife as an example. I'm an agent. I come to Ife house, say, look, Ife, I'm going to write policy for you. Then Cynthia is another agent. After I write a policy of $1 million to Ife, I made it a way that Ife is paying $1,000 every month. Now, Cynthia comes. Cynthia is Ife's friend. When Ife told Cynthia, look, I wrote a policy, Cynthia will ask Ife, how much are you paying? He said, I'm paying $1,000 every month. How much policy? If he said 1 million. Cynthia said, no. Why? No, it's too much. I can give you the same policy, $1 million, you pay $500. By then, you know what Ife will say. If he say, really? If he will not remember that already has started that policy, Cynthia will told her to cancel the policy. She will go along and cancel. Now, Cynthia will come and design a policy, $1 million, that you are paying $500. That $500 you are paying for that $1 million is just keeping the policy. It's just maybe to keep the policy alive. But when I designed the one you are paying $1,000, I made it a way that, look, within 2 years, at least within 2 years or within 1 year, you have had a good cash value, because I designed that policy with the intent for you to accumulate, for accumulation to be more. But this person designed it to just keep the policy alive. Yes, that's what people don't know.
So that can be called twisting. There.
No, it's not. You see, most times, will you call it twisting? Of course, sometimes, somehow. But the insurance industry cannot come along to begin to, of course, most times the advice is don't cancel your policy, whatever. So, but the insurance industry cannot come and say, maybe that is twisting. It's the game. If you know, if you understand, now that you guys are entering, you begin to understand this, that she is paying $500 for the same $1 million policy. She is barely keeping the policy alive. But I made it a way that she pay 1,000. Because remember, when you pay the premium, the premium are divided into different sections. Some parts will go to cash value. Remember when I said that? Some parts will be used as cost of insurance. Some part we use go to claims. Some part we use to pay commissions. So for Cynthia coming to tell you that he will give you $1 million policy and you pay 500. She is only concerned to make a commission.
Mm-hmm.
But I come to tell you that, look, listen, pay 1,000. It's good for you. I made it with the intent for you to make a gain in future, not now. So these are the things people do not understand, and more especially, I don't want to call their name here. We are live, but there's some cross section of other people that may not have the same color I will have, always do to, because they believe that we so much love cheap thing, they will go that to get us. Yes, they use that to get us. Then some of us who are so myopic, we say, oh, I like doing these things with them because they're sincere. They can never be sincere more than your brother and your sister. That is the truth, whether you like it or not. That is a complete truth, whether you like it or not. That is the truth. They give you that without thinking about the consequences. But me, if I'm doing it to you, I'm thinking about what of tomorrow if something happened, you will come and ask me, why did I do this? All right, let me shock you guys again. Do you know somebody has written policy for somebody? There's no rider on it. Yes, we have seen it so many times.
Maybe they didn't know what the rider is.
You don't give what you don't have. That's the basic truth. You don't give what you don't have. You can never give what you don't have. You have to have before you give. Yeah, severally, people have come open their policy. There's no rider. They did just question of maybe you see like this place I highlighted, just click, just one click to add a rider on it. And that rider is supposed to be automatic, but it's whether you like it or whether you want it. If you want it, automatic. If you don't want it, you don't want it. So what you just need is just to do what? Do a one-time click. But you cannot give what you don't have. Yes, that's the basic truth. So more especially, you can see that what I'm doing here, I'm not just doing maybe for everybody to pass the exam. I'm giving you the basic foundation to even start the business. That is what it is. And that's basically what you see, which means when you go out there, you'll be strong enough to listen and understand. You now begin to ask a question that looks very, very intelligent because you now know what it means, at least.
Engineer, question.
Go ahead.
Please. Does it mean a policy that is active, can you unclick the what is it called? Can you add long-term care? Can you add long-term care to already existing?
No. The click I mean is that all those things comes when the policy is being designed.
It's being designed.
When you are filling up all those informations, when you are submitting, you can do that during the free look period. You can do that, but immediately is the policy become binding. It can no longer do correction on it. So what they will tell you to go and write new policy.
New one, okay.
Yeah.
Thank you.
So that is the premium mode. Let's go to the more frequent the payment, the higher the policy will cost. Look at this. Look at what he said here. The more frequent the payment, the higher the policy will cost the insured in total. Did you see it? The more you pay monthly, the policy will be higher in the long run. They decide to pay every 6 months or decide to pay annually. Basically, our advice to everybody is that pay if you can't pay annually. You are reducing it, and more especially, you are making impact to your cash value. Like the most important thing is to make impact to your cash value so that if any eventuality comes, you can go there based on your cash value to make a withdrawal or to take a loan, which means you are like building a good bank for yourself. But if you continue to pay monthly, it's going to take you at least 3 to 4 years before you begin to see any small cash value in there. But if you pay annually, within 1 year, you see a good cash value. That's the truth.
Okay.
Yeah. So the more frequent you pay, the more expensive the policy is. So you don't need to continue to the premium. You don't need to make the premium mode short. Extend the premium mode. You see a good result. So another thing we're going to talk about now is the earned income, earned premium, and unearned premium. On that, I'm going to use your own local bill payments. All of us here is paying bill. Who is not paying bill here? Who doesn't know what bill payment is? I don't think anybody in America doesn't know what bill payment is. So all of us are paying bill. Let's assume you are paying your electric bill. Today is what? Today is February 17th. Today is February 17th, I hope. Today is February 17th. Let me use one person as an example. All right, let me use, all right, if he's on the top. All right, let me ask you this question. You are paying your electricity bill. Have you paid for your electricity bill this month?
Not even know. I just do with
Autopay.
automatic withdrawal.
Autopay. All right, let's assume you have paid your electricity bill for this month. Let's assume that you have paid. Today is 17th. Let's assume you paid today, 17th of February. That's the day you pay your electric bill. I want to use this scenario now to explain earned and unearned premium. So remember, this is February, month of February, and you paid today, 17th. So if you have paid today, and this is month of February, means that from February 1st to 17th of February, you have paid for it. Or let's assume you paid on 1st of February. You paid on 1st of February. Every beginning of a month you pay. Every beginning of a month you pay. Now you pay 1st of February and today is 17th. It meaning that now you have paid the electricity bill from 1st to 17th. You paid from 1st to 17th. However, you have paid for the whole month from 1st of February to 28th, which is February 28th this year. Yeah, you paid 1st of February. It means that you have paid the whole of the month. Of course, if you don't pay the whole of the month, they're going to cut your light. That is the truth. So you pay ahead. We are paying bills ahead of time. Like months, water too, you are paying ahead of time. Even for our mortgages, we pay ahead of time. That's what we do. We pay if you live in an apartment, you pay ahead of time. So which means for this month of February, everybody has paid his mortgages now. For electricity, you have already paid for this month. So the earned income or the earned premium for that electricity which you have paid this month is the earned premium to the electricity company is from 1st to today being 17th. That is earned income or earned premium. Then the unearned premium is from tomorrow, which is 18th of February to 28th of February. That is unearned premium. So I'm using this explanation to explain this to everybody so you can understand what I mean. We are talking about earned premium and unearned premium. Earned premium and unearned premium. So the earned premium, which the electricity company or their mortgage company you have paid for, the earned premium for them is from the 1st of February to 17th of February, which is today. Today, they have kids today. They have kids today, which means they have eaten their money for today. So for that electricity company, today they have eaten their money for 17th of February, which means from 1st to 17th. Let's assume you are moving out from your house. If you're moving out from your house now, you call them today, say you want to electricity bill to stop today. If you're moving out, they will calculate your money from tomorrow, which is 18th of February to 28th of February, which you have paid. They will return that money back to you. Yeah, even your mortgage. If you call your mortgage people now, say, look, your apartment, but apartment people most of them are criminal. They don't do the right thing. But if you call them that you no longer want to live, that you are moving out today, they have earned, the earned money which you have paid them for this month is from 1st of February to 17th of February. They're supposed to pay you back 18th of February, 28th of February. That is unearned. You have paid them already, but they have not earned it. The one they have earned, the day have just passed. The day you have not attained to is regarded as unearned. So based on that, earned premium is what? Is a prorated amount of paid in advance premium that the insurance company has earned by already providing the insured coverage.
Okay.
So the day you have stayed, you have paid them, that one is earned. They have earned it. The one they have killed that one, which means they have given you service on that one. From tomorrow, 18th of February, they have not given you service on that. So that one they have not given you service on, if you call them today, on the day they have given you service of, tell them that, look, you're no longer in this business, that they should, that you're canceling. They're going to return to you from 18th of February to 28th. Is the same thing applies to auto insurance too. If you have a good, like immediately you pass your exam, that's what I advise everybody to do. If you pass the exam, assign into your platform, do everything finish, go into boats, refer yourself to boats. They will call you, you tell them their address and everything. Call me, I can help you do that. Give them your address and everything. They will do what? They will go through, when they submit the quotations to you, you will check all the quotations they give you, compare it with what you are paying presently. If you compare it, now we see anyone that's cheaper than what you have, you go for it. Then you can now call the insurance company and say, look, I don't want you guys again. I'm canceling my policy from today. The insurance company, their auto insurance company or home insurance company. You call them that, look, you are canceling. Immediately you call them you are canceling, the other one will kick in. Then the first one which you have canceled will pay you from that day you canceled to the end of the month for that month. They pay you back. So that one that pay you back is the premium they have not earned. And that's why we call it unearned premium. The one they have eaten, which is the one they have killed. To me, I use the word killed. The one have they killed. In those days you have passed. With the days you have given you service on. That one is called the earned premium. All right. I think everybody who does not understand it, earned and unearned premium. We're not going to read this in this explanation I give is enough to everyone to understand it. So policy term, of course, policy term is always seen in term insurance. Is a period of time during which the policy remains in existence as long as premiums are being paid. That one is seen is what in term insurance. Policy fee is a small transaction fee charged by some insurer for the first or subsequent years of insurance policy. In addition to what the regular premium, policy fees are either paid annually or one time when the policy is issued. So the policy fee we are talking about is also in your premium. Policy fee or cost of insurance, all of them is in your premium. Immediately you pay that premium, the premium will be distributed to different channels. And that is why in life insurance with living benefit, which we call life insurance, the life insurance, permanent or whole life insurance, they don't have what we call return of premium rider. Return of premium rider. They don't have it. What they have is what? Non-forfeiture value, which is the cash value. And remember, the cash value is part of the premium. There's part of the premium you pay, which is channeled back to the which can start to build and yield interest for you. That's the cash value. And of course, the basis of why we're speaking today and why everybody now want to get life insurance, because we have understood there's a cash value. So that part of the premium you pay that goes to the cash value is the one the insurance company is giving you back. I want everybody to get that. That cash value is going back to you. They are giving it back to you. That part is being given back to you. That's why we call it non-forfeiture. You pay 500. If 100 goes to the cash value, it means that that 100 is given back to you. You pay 500. If 200 is given back, is go to the cash value, it means that that 200 is given back to you. To start yielding interest for you. Do you have it on term life insurance? No, it's not there. So that's why in term life insurance, you have what we call the return of premium rider. So even if you do not have a return, if you have life insurance, you do not ask for return of premium rider, they are not going to give it to you. Which means if the time your policy with term, you cannot get nothing. All that you pay will go. But if you have a return of premium rider in your term policy, yes, of course. If you terminate your policy or your policy terms, or you decide to say that I don't want it no more, they will calculate the premium you paid and remove the expenses they made, and they will give you back whatever remains. At least small is better than none. So in such case, if you have a policy and the policy terms, at the age terms, the premium will not depend on the new age. If you cannot be able to afford it, they will calculate the premium you paid, remove the charges, and give you what? Give you back your money. But if you don't have return on premium rider, they're not going to give you nothing. If the policy terms, your term policy terms, you do not renew it, there it goes, you lose everything. So most of the people who wrote policy by the other people gives us term policy because they don't believe we can afford whole life or permanent life insurance. That is the truth. We believe it or not. I remember in those days, if we have our baby, they will come to the bedside, say they're going to give us GABA. I don't know whether anybody know about GABA. Yeah, they will come to you. Somebody, if you born newly, in most especially in Texas or Dallas, they will come to you and say they're going to give you GABA. They will preach you, say it's $10 every month or $2 every month. They give you GABA. They will not give you alternative to GABA. And because we do not know, we don't ask them the question, what is alternative to GABA? Because they assume that we cannot be able to pay the other one. They now give us GABA, $10, $20. And you see how people will jump in to buy it. And the same are people, if you talk to them tomorrow, to ask them about policy, they say they're okay, they have gotten it all. They have gotten policy for them and their family. Investigate well. What they have is term policy. Except these days that people have started indicating a lot of people. People who are getting policy nowadays are getting the right policy. That is the basic truth. But those people who get policy before, they get term policy, all of them, including me. I got my first policy in 2007. What did I get? Is term policy. So anybody who tell you otherwise saying he knows all, he's lying to himself. He doesn't want to say the truth. Thank God this business is exposing everybody. Nobody want to say lie before. If I'm not here, if I'm not in business, if you guys ask me, do I have policy? I say, yes, I have good policy. That's what I say. Meanwhile, it's what? It's not policy.
It is so.
And I see the worst. My own was, I was so inquisitive. I asked the man, I could remember now 2007. I asked the man, say, what if tomorrow I didn't get money to pay, or maybe tomorrow I don't want to pay no more? Can they, with my money lost? He said, yeah. He said, if I want, he can put my money will not lose. I said, put it. He said, when you put it, you're going to increase the premium. I said, put it. So he has to put return of premium for me. Most people who have term policy does not have return of premium. If you do not ask, you will not get it, except your agent knows what he's doing. He will present it to you, say, oh, in case so, in case so, will you want this? You say, yes, you want it. He tell you that you're going to increase, your premium increase, say, look, go ahead. Instead of me to lose, let it increase. But if you don't have that kind of mindset, or that agent does not care to ask you, believe you me, you're not going to get it. When the policy term, you are gone. In fact, the other people will not even ask you. That is the truth. That is the truth. They will not ask you. It's the only person who have you at hand, or if you know, or if you raise up the question, or the people have you at heart, we ask such question. Otherwise, they're not going to ask. What they know is just go, they get their commission, period. So we have said the formula for calculating health insurance premium is what? Mobility minus interest plus expenses. That's what we said. And we know in most life insurance companies, they have morbidity table. Morbidity is quite different from mortality. I hope everybody knows that. Morbidity is quite different from mortality. Child laughs, sorry, please. Who is child Lohas? Sorry, I don't know what I pronounce it well. Sorry, who is child?
Chilugas.
Huh? Oh, Chilugas. Sorry, I was pronouncing the name in the morning.
Yeah, this morning. Yes.
I nearly bite my teeth.
Yes, sorry about that. I was my hand was tied up at the time you were asking for the name this morning. But I had you though. How are you, sir?
I'm good. I'm good. So, who's your business partner? I just want to know. We have somebody that we're not supposed to have. Well, who's your business partner, please?
Cecilia Bilom.
Oh, Celia Bilom. So you're welcome. You're welcome. All right.
Thank you.
Celia is our champion.
I know.
She's our champion.
Yeah.
She just started yesterday, but she's already in 70. She's a champion.
Yes, I know. Thank you, sir.
Oh, you're welcome. I think everybody here, I know everybody here. All right, so let's go. So the morbidity is not the same as mortality. Please, you should know that. Morbidity here, what they mean by morbidity is in every company, insurance company have their morbidity table. In that morbidity table, if they classify you, they check their mobility rate, they speedily tell you what your risk level will be and your premium. Most companies, they don't go to begin to do calculation using this one. They don't use it because if every time they're calculating, you know it's going to be a problem. So what they want to do is they want to see your age. Based on your age and your risk level, they calculate your morbidity. Sharp. They don't need to begin to do calculation. This is for one person or two person. For multiple people, they have a table. So is mobility tables reveals what the frequency, the extent and duration of what disability expected within a given group of persons. So the mobility table help them to determine your premium. It indicates what the average number of persons in specific group. That is now definition of mobility. The average what number of persons in a specific group expected to become disabled in a given year at a given age. That is what mobility. Mortality is the rate at which people die.
I like that definition.
At that particular community. So this one is mobility. So be able to understand there's a difference. There's always a difference, so be able to know that. So the actuaries, this word, I would just want everybody to know it. I've not seen it in an exam, but in case if you see it, is what is used, they use the actuary tables to do what? To find ratios to compute policy premium rates. So I think what you need to know is just no morbidity, The interest, what is the interest there? In every insurance premium, there's always an interest attached to it. There's always an end interest. Do you earn interest in what do you call it? In term life insurance? Is there any interest in term life insurance? Can anybody help us? Is there any interest in term life insurance? Of course.
No.
Why?
Because it doesn't yield, it doesn't have a cash value.
No, it doesn't have a cash value. That is it. It doesn't have a cash value. So there's no interest. So you can only see interest in cash value life insurance, which is permanent or whole life insurance. That's where you see interest. So interest was insurance companies invest the premium payment they receive from policyholder to earn interest. All right. Term life insurance doesn't have interest to favor you, but does it have interest to the insurance company? Of course, yes. If you remember, all this money we see, the money is circulating around. You carry your money, put in a bank. Banks turn around, carry the same money you put in a bank to go and put in life insurance policy to compound and the index for them. Then the insurance company, who that money is stocked on them, use that money to go and invest to get interest. Nobody keeps money in one place. In fact, if you get money today, you just keep it in the bank to be looking at it. That money, you are just keep redundantly, you are putting the money in a standstill. Money is not supposed to be in one place. For you to earn it and get more, it's supposed to be circulating. When it's circulating, it's bringing interest. Interest is what increases your wealth, not keeping it in one place. I told this story every time. I had this lady, she's a nurse, a young lady, not up to 30 years age. She has in her bank close to $200,000. Yes. She opened the account. I see it with my eye. I called her, come, Chidera. You know what you do? This money keep here looks insane. To me, it looks stupid. Some people have money in this country, they can't even do up to 200,000 in their account, in their accounts, checking account or saving account. How much you're going to be making in a month, in a year, in a checking account, even on a saving account, it can be up to $10. So I told her, as young as you are, can you close eye, bring up 50,000 to go and open an annuity? You are 30, or you are 29, getting to 30. Can you bring up 50,000? All right, 25,000. Go and open a good annuity. Then go and write policy. You are still young. They will qualify you now. If you wait in the next 2 years, 3 years, you never know what will happen. And by then, you may not be able to qualify. You know what she told me? She said, no, Mr. Pat, I want my money to be where I'll be seeing it every day. Yes, that was the response. I keep on pushing. She keep on, as a single lady and as a Gen Z, you don't want to praise them more. At the point, they begin as if you are bothering them, So she said she want to keep it.
I thought she was an old lady. All this time, I thought it was an old lady.
Oh, she's young. She's not yet married.
Young person talk like that?
Because you are talking like this because you are here, you know it.
Well, she's from Africa.
Of course. She's a Nigerian. Yeah. So just imagine this lady, 30 years old. She carry 50,000, go put annuity. Do fixed index annuity.
My God.
You know the advantage she got? Age is on her side.
Of course.
And she now go open 500,000 life insurance, even 1 million life insurance.
And she's
bring another 20,000 or 25,000, put on life insurance, pay annually. You know what I mean? This lady has, if you can do these two things, she have already put herself in the right track for retirement. She still have up to 100,000 in the bank that she'll be seeing every day, so that she can be happy.
That's about $7,500 extra.
She has money that she can put and still have money there.
That's 15%.
So, but is this education? Imagine if this lady has parents who are in this business. Do you think the lady will be saying, I keep my money where I'll be seeing it? No. Because the parents will be pushing. Yes, just like as I am now, my daughter is saying, put money where he'll be seeing it. No, she can't say that now. She can't just say that. She says she looks stupid. In fact, if I tell her the story, she'll be laughing. If she have a phone, she can call the person. I know her. She can call the person. Say, Auntie, don't do that. So, but is education
Engineer, there's a pharmacist that I spoke to about his 401k. This is what he also said, that
Yes.
he's good looking at it there. He's good looking at it there. A pharmacist.
Or imagine a pharmacist.
Yeah, retired.
Retired pharmacist.
Yeah, that means there's 401k somewhere. Yeah, there is.
Yes, there are 401k somewhere.
Yeah, there is.
All right,
He
imagine.
say he likes to look at it like that.
If it makes him happy, don't take his happiness away. Let him be.
That is the ignorance happiness.
Oh my God.
That is the honestly, once you guys pass your license, you'll be seeing a lot of people, you'll be seeing a lot of stories. In fact, sometimes you'll be laughing. Because now you know it. When you don't know it, you are just like them. But when you know it, you will just behaving. I remember in those days that we are children, we are in high school. You know, when boys are in high school, your head is hot in Africa. You're in boys' high school, you are so hot then. They call us one day to come and learn how to do choir. They say Bishop is coming, that we should come and learn how to sing. Imagine you go carry boys, when they find what they go do. Now we go sing. So we go there. We go one day. They come pack all of us from school. They go one day. So when we are doing the practice, all of us begin to laugh. All of us begin to laugh. The Reverend Father says, "These boys are assaulted. Come on, you guys will go back to your school." They told the sister, say, "Go and look for women, not these boys." So in essence, what I'm trying to tell you is this: when you don't know it, it becomes a mirage. Then in the same boys that we are, three among us who are so quiet still come out to be among the people that sing. But some of us who doesn't believe in that, who are our head not here, we left, we go our own way. When the father said that, we go our own way. But see, three good boys stay and follow the people to sing. So that is exactly how it is. Daniel will say, not everybody will do this business. Of course, that is the truth. If everybody become rich, there'll be a problem. There are people who wash the car. There are people who sweep the road. But one thing we keep on saying that don't allow your family to become the people who will sweep the road or wash the car. But however, there's people who will do that. Basically, that's the truth. That is the basic truth. Some people believe, some people will not believe, but continue to push. Those who believe will enter into your track to believe what you believe on, and they will never regret. None of you here today, whether you pass this exam or not, I believe everybody pass, you will not regret getting this knowledge. I'm telling the truth. Then imagine what the knowledge will be if you continue to be in this platform in the next 1-2 years. That is how it is. So, of course, that is the interest. Interest comes from whatever we put in. It's an insurance company invests premium payments they receive from policyholders to earn interest. They invest it. The banks invest it. Walmart invest it. This one that say coffee. I don't go there. The one that say coffee, what they call it?
Starbucks.
Starbucks have it. All of them have it. Bank of America have it. Chase Bank have it. Wells Fargo, all those banks, they have it. You put your money there, you turn back, they go credit and invest in life insurance. You come back, say you want your money. They ask you, why do you need the money? Meanwhile, it's you that bring the money there. They'll ask you, why do you need the money? What is this for? Don't you think somebody want to play you? Meanwhile, with your leg, with your senses, you take the money there, but to get it back, you don't want to take all of them all. You just want to take small. You want to just take small, they will not allow you because the money is not there with them. The money is somewhere else.
You see them going from one office to the other, the other.
They're just going to consult people. They're not. They're consulting their big organ to know the decision they will tell you. So sometimes, if the money is not there, they're going to call another branch to bring the money from back door. That's what they do. So the interest earned on premium is what is one way that an insurance company can lower its premium rates. So when insurance companies calculate policy premium, they assume they will earn a specific interest rate. The higher the assumed predicted, or of course, rate of interest, the lower the premium will be. The actual interest earned may be higher or lower than the assumed rate. So you know that, I don't want to talk more about that. When you begin when you begin the business, there's what we call cap. I don't want to go through that, it's deep. There's what we call cap. That cap is what your interest is based on. When you have life insurance policy, cash value life insurance policy, index specifically, they'll tell you they cap it on from so range to so range. You will know that when you begin the business. So that basically, that's what helps in you knowing where you place your money and what the intent of the policy is. You must have intent of the policy. What do you want the policy for? What is the target? You must have it in mind before you write a policy. So the expenses factor is also referred as the loading charge, or loading factor. Is derived from what operating expenses or the funds that the insurer pays out. Some of these expenses include what? Agent commission, wages for other employees and administrative costs, overhead expenses, which is the rent, and the regulatory requirement to set aside reserve to pay future claim. So from that year premium, there's all this will come out. More especially, the insurance company prepare themselves for claims that will come in future. So as you pay your premium, what part of the premium is designated to go to reserve, where they will use to pay future claims, not for you, general. So every insurance company have a reserve for future claims. So that's why even if no matter how big that claim is, the insurance company can afford it, because they have a reserve, a money they don't touch that goes for claim payments. And this is one of the things the rating companies check in every insurance company. I hope everybody remember the 4 rating companies. This is one of the things they check in every insurance company to know whether they have provision for future claims and how much do they have for future claims. Those 4 rating companies, that's what they do. All right, so let's go to this is a scenario. This scenario is exactly what we have been saying before. There's no need to waste our time there. We don't need to waste our time there. With the little you know, with the little we have just discussed now, to help you to get the exam, but I want everybody to pay attention to what we're saying, because basically this chapter is almost telling you everything you will do as an agent. It's about health insurance, but it also applies in life insurance. So benefits. I said if there is no loss, there will be no benefit. Of course, if you don't have any loss, there will be no benefit. Remember the insuring clause, the promise to pay the benefit, of which we say is conditional. Is conditional in the sense that there must be a loss before the benefit can be paid. If somebody have a life insurance, whether term life insurance or whole life or permanent life insurance, whichever one it is, if the person they insured did not die, there will be no benefit. However, that applies only to term life insurance. But in the present insurance which we are doing that have a living benefit, the insured can wake up tomorrow morning, he doesn't have money. He has a big problem on his face. He checked up and down, checked front and back, no other place to get money to solve that problem. He can go to the policy he has and take a loan or take a withdrawal, as the case may be. Assumed he takes a loan of 500 or 50,000 or 60,000 or 100,000, he's going to pay interest on it, 2% interest. If you go to a bank and take a loan of 100,000, I don't think you pay 2% interest. You're going to pay close to 30 something, close to 15 to 20% interest. However, there must be a collateral before that money be given to you. But here, you come and make a call. The father that you have money in your cash value, they'll just give it to you. It's your money. Remember, the part of the money that goes to cash value is not for future. Means that it's your money. I hope everybody remember that. So it's part of the premium that they send to compound for you. So it's your money. You're gonna get it back. It's not for future. So that's a benefit. There's no benefit that can come without a loss. So the greater the amount of the policy benefit, the higher the premium. I want everybody to understand this, please. It's the number, level, and type of benefits that a policy provides affects the premium. The number, level, and type of benefit that a policy provides affects the premium rates. Now, the greater the amount of policy benefit, the higher the premium. Or put in another way, the greater the insurance company's risk, the higher the premium. The greater the amount of policy benefit, the higher the premium. Let me bring it down so that everybody will get it. The greater the amount of policy benefit, the higher the premium. What is the policy benefit? Who can tell me what is policy benefit?
Like the face amount.
The face amount, yeah. You call it benefit, policy face amount, face value, or you call it dead benefit. Dead benefit. It's dead benefit. So that policy benefit is the dead benefit. It's also called the policy face amount. It's also called the policy value. So that is the benefit. So what we are saying that the greater the amount of policy benefit, the higher the premium. Of course, you know that. If you write a policy of 200,000 and Miriam writes a policy of 500,000, we're not going to pay the same premium, because the greater the policy benefit, which is the first amount, the higher the premium. If you go and get a policy of 1 million, and after you come another that day, same day, you get another policy of 500,000. It's not gonna be the same premium. The one of 1 million will be higher. So the greater the policy benefit or face amount, the higher the premium. In other words, the greater the risk insurance company risk, the higher the premium. The person who has a preferred risk cannot pay the same premium with the person who have substandard risk. Of course, you have seen that 15 and 50%. They're not the same. If you have a standard risk, you cannot pay the same premium with a substandard risk. So the greater the risk value, the greater the premium, or the higher the risk value, the higher the premium. So I think everybody got it. So what is now the benefit period? In life insurance, you design it the way you like. In term short life insurance, you design it the way you like. In whole life or permanent life, you design it the way you want. How do you want the benefit to be paid? All these things are done during the policy design. During the time you guys are filling the form, that's where you do all this. You want to say how you want it. Now, in term life, the most common benefit periods in term life is what? 12, 24, or 30 months, or 5 years, or 10 years, or 20, as the case may be, whatever you like. You can do it for life, but especially in annuity, the benefit period, you can decide to put the benefit period till life, till the person passes. But the only time that you put the benefit period till the person passes, what happened? In some of the situations, there may be no beneficiary to collect the remaining. The company, insurance company, got the money. Anyway, that is on annuity. We don't want to talk about that one here. I know most people don't want to hear that one. Most people don't want to hear that one. So the benefit period is the maximum period during which an insured collect monthly income will also affect the premium charged. Remember, as you pay, the premium mode determines how much you pay. I hope you know that. If for annually, you pay less than when you pay monthly. Yeah, that is for premium mode. Now, we are talking about benefit period. If you decide your benefit period to be monthly, it's going to affect the premium charge. If you decide that your premium mode will be annually, then definitely you're going to get more benefits. But if the premium mode is monthly, your premium will reduce. Just like if you win a lottery, if you decide to collect it at the same time, the tax you pay need to be more than will be more half of the amount you win if you win a lottery. So if you decide to make a deal and be taking it every year or every 3 years, you see that, or even to invest it in annuity, you see that you'll be making money gradually. But if you want to collect it one day, the tax that we impose on it will be more. For those who have win lottery before, we understand. So that is the premium benefit period. The elimination period is what? Is a waiting period, is common to most types of disability income insurance and looks like a deductible. Waiting period is the period you stay before what? I mean, the elimination period are also called a waiting period. Remember, elimination period is also called a waiting period. Write it down on your note if you have a note. Elimination period is also called the waiting period. The waiting period is the period in which the disabling or disability occurs and you file a claim. From the period you file a claim to when you begin to receive your first benefit. That is what we call the waiting period. Do you pay during the waiting period? Of course, no. So on each occasion, an insured becomes totally disabled, a waiting period must be satisfied before any monthly benefit is payable. The longer the selected waiting period, the lower the policy premium. Did you see it? Yes. If you put the waiting period longer, the policy premium will be lower. If you put the waiting period shorter, the policy premium will be high. So you can write that one down too on the waiting period and the waiting period or elimination period. The longer the waiting period, the what?
The higher the money.
No, the longer the waiting period, the shorter the premium.
Oh, I think they are making interest from the longer they're keeping it.
No, what they mean is they're talking about the benefit, the premium and the benefit. All right, look at this one, the period we said before. Let's go back to the period so we see it. They said, you can write it down so you will not get confused. The greater the amount of policy benefit, if you have a policy benefit that is higher, what will happen to the premium? The premium too will be high. That one is understood. The greater the amount of policy benefit, the higher the premium. Now, the greater the insurance company risk value, the higher the premium too. This one is for premium. The greater the policy benefit, the greater the premium. And again, the greater the risk or the higher the risk company risk level, the higher the premium. Now let's come to the elimination period or the waiting period. It said a waiting period, which is also the elimination period, it said the greater, all right, it said before totally disabling, a waiting period must be satisfied before any monthly benefit is payable. For you to get this in your mind, you get to write it down so that you look at it anytime, maybe accidentally look at it. They said the longer, remember, we use the word longer and we solely use the word higher. You see, that's what we should be aware of. The longer the selected waiting period, the lower the policy premium. Like if the waiting period is long, what's the waiting period? In waiting period, do they pay in waiting period? No. The waiting period is the period from the time the disabling occurs
to the time they start paying you.
That is the waiting period or elimination period. So if you make that period so long, your premium will be what?
Shorter.
Will be shorter. You have a shorter period. Now, if you turn this upside down, said if your waiting period is shorter, what will happen to your premium?
It's going to be higher.
Going to be higher. So at least we know it now. The longer the selected waiting period, the lower the policy premium. You revise it, turn it upside down. Now, if it's shorter, what will happen to your waiting period? What happened to your premium? Sorry.
Say that again.
If it's shorter, what will happen to your premium? Your premium
will be higher.
Yeah, that's what I want everyone to know. So you can write it on your own so that it will not confuse you.
Maybe they had
Sometimes
started
you
already.
just blaze into it, you look at it.
Just know that when one go up, one other will be down.
Yeah. Just write it on your own words. That will help you to remember it. This waiting period and or waiting or elimination period, just know what it is. Know that the waiting period is the period when the disability occurs. The period from the time you file a claim to when you begin to receive your benefit, that's the waiting period. Do they pay the benefit during the waiting period? No. So the benefit period starts immediately the elimination or waiting period ends.
Which period that?
Huh?
Elimination.
We're talking about elimination. Elimination is also called a waiting period.
No. I thought it says that, not that. I heard something else after that.
Oh no, there's not. All right, let's go to the another period called the probationary period. Probationary period. You can write it down too. There's a lot of periods. It confuses. So for you, those who have written it, who have come out of the exam will tell you that they see some of this. And sometimes because there's a lot of them, you see, you get confused. You don't know which one is which. So we have talked about elimination or waiting period. Let's talk about the probationary period. Probationary, all of us, even now, should know that when you get a work, when you get a new job, sometimes they give you 6 months for probation. After the 6 months, you become a full staff. I hope it happens in every company. There must be a probationary period. So apply it in insurance. Probationary period is the same thing everywhere. So is one-time event that must be satisfied before a health insurance policy coverage becomes effective. If you enroll in health insurance, it cannot be effective immediately. If you're effective there's sometimes they tell you 1 month. So you have to wait. 1 month. So I think most times it's 1 month. Oh yeah, 30 days. There's like 30 days period. So sometimes they tell you 30 days. So that period you stay until it become effective is called the probationary period. Or if you get a job, they tell you have to work for 6 months before your benefit came. So that 6 months you waited before the benefit starts is called the probationary period. So I want you to know it on your own definition in this way. So probationary period is always 30 days. You can write it down. It's always 30 days. So just know it, what the meaning is. So when you go to the hall, you see probationary period. By your own personal definition, you have known what it is. So you don't need to maybe to cram what they write here. No, you don't pass the exam that way. Just know what it means on your own word. So when you get to hall, they may not use the same sentence they use here. They're going to use it the way to confuse you. So you now boil down on, do you know what the word mean? So probationary period, that's what it is. Sorry, this chapter is big. It doesn't end. So we now look at element that influences morbidity calculation. We did premium calculation where we say morbidity minus expenses plus interest. That is morbidity for calculating premium, what we say. So what the element that influences morbidity? What influences morbidity is claim experience, or we now talk about claim experience, age and sex of the insured, occupation and hobbies, community ratings. Remember, what do we use in community ratings? What do we use in community ratings? Is community ratings used for small or larger group?
Smaller group.
Good. What of experience rating?
Larger group.
So yeah, community rating is used for smaller group. Experience rating is used for larger group. Is the exam question, please. Community rating is used for smaller group. Experience rating is used for larger group. And they are using community rating to know the risk level, please. So you use community rating when they are dealing with smaller group, and they use experience rating when they're using a larger group. The reason is this: they cannot use experience to rate the smaller group. So that's why in community rating, they use what? A smaller group, and the experience rating, larger group. So that's what all of us should know. the initial premium and premium receipts. All right, now we'll come to where most people get confused, and most times, if you can get to hall, you may see up to 6 questions on this application issue. Now, remember, you write the application, you can submit the application with initial premium, and you can also submit the application without initial premium. I hope everybody knows that. You can submit your application with initial premium, and you can submit application without initial premium. So any application you submit without initial premium is called what? Trial application. Trial application. Any application you submit without initial premium is referred to as what? Trial application. So what is a trial application? It's an application you submit without initial premium. All right, I think everybody get that one. So let's go ahead. So let's first of all deal with premium paid with the application. You're gonna deal with premium paid with application, application without premium. You're gonna look at it. So let's first of all decide on premium paid with application, which means you are submitting application with initial premium. So that is the first one. Then we now decide submitting application without initial premium. It's always a scenario questions that comes out of it when you submit application with initial premium. You are the agent, which will be, you have somebody, you are writing application. Let's assume Miss Maria is an agent and Maria is writing application for Miss Cynthia. Now, Maria will come to Cynthia's house and give her all the teaching she needed for that application. And they finish the application. Miss Cynthia said, oh, I'm going to pay my initial premium with the application. That's what we mean by submitting application with initial premium. So if Miss Cynthia said that, Maria will say, all right. So Maria will now collect the initial premium from Miss Cynthia and give her what we call a conditional receipt. That conditional receipt does not show that Maria has gotten an application. Miss Cynthia has gotten an application. The application has been approved. Is that conditional receipt is just to tell her that, look, I collected money from you for the initial premium and the application has been submitted. So that is submit application with initial premium. The other one is that you submit application without initial premium. You just fill the form and submit to the underwriter. The underwriter goes with it, goes through it, collect all the things he needed to approve or deny the policy, and he finally approved the policy. Now you are informed to pay the premium. That is what submitting application without initial premium. So it is a general in the proposed insured best interest to pay the initial premium with their application and to have the agent forward it to the insurer. This is where agents always enter into problem. Let's assume you submit application with initial premium. The agent give you, the customer, after filling the form, she or he give you initial premium. It's their duty as an agent to submit the application with initial premium immediately direct to the insurance company, the underwriter. If you do not do it, anything happened to that client that time, you are liable for question. First, they have to ask you some questions, which you may answer or may not. So remember, when the initial premium is paid to you and you submit the application and you carry that money given to you, put it in your pocket, you have mixed it with your money in the money you have in your pocket. What you have committed a offense called commingling. Commingling is another thing you may see in the exam. Commingling is mixing the premium with your own personal money. It's called commingling. Any question? All right. So let's go ahead and say there will be, all right, the proposed insurance will benefit because the insurance carrier will immediately extend insurance protection. However, there will be significant restriction. The producer, who is also the agent, who is also the feed underwriter, should collect a premium from the applicant at the time of application or as early as possible thereafter. So it's their duty to collect it, but most of the time we do everything online, so you do not think about even collecting it. But for exam purposes, if you collect it, if you do not collect it, it's called trial application. If you collect it, then you have to go all the processes. So the premium is what generally forwarded with the application to the underwriting department. If you collect it, just forward the premium with the application to the underwriter immediately. You don't need to waste time. Remember, if you waste time, something can happen to the clients. Yes, something can happen to the client. If you waste time, the client can be in trouble. Yes, it's true. If the client, after writing the application, submitting the initial premium, will go out, a car hits him, he dies. Yes, become a big trouble for the agent. So as you're collecting the initial premium, submit it immediately. Don't waste time. Otherwise, you're going to answer a lot of questions. So that's one of the things everybody should have in mind, please. So if an agent, although what happened nowadays is that because of that problem, most insurance companies now they tell you to do online. Put your banking information online and fill the form and do a trial application and go your own way. They will now leave it to the underwriters to approve or deny. If they approve you, they will not inform you that a policy has been approved. Then you expect you to pay the initial premium. So, but when you submit with the initial premium, the effective date of that day becomes the day you submitted the application or the day the check was made. So now let me add this question. We asked it yesterday morning or even, yesterday or in the evening. I said, if somebody submit application with initial premium and the applicants left the place and the agent has fastly submit the application with initial premium to the field underwriter, the insurance field underwriter in the office, and within that day, the applicant died in accident. So the question will be, do you think there'll be benefit for the beneficiary of the applicants or not?
There might be if they come back and say that he was approved. If they didn't find anything that could have stopped them from giving him the policy, they might pay him.
Yes.
And knowing these people, they might, to avoid paying him, they might come up with something.
There's always a question on that. Of course. So any other person? Any other person? What's your own view? Any other person? In that scenario, we just ask any other person that somebody wrote up. Maria wrote application, but Maria was a smart agent. Maria sent the application and initial premium straight to the insurance company. Now the same day, the applicant had an accident and died. Will the insurance company pay that benefit to the beneficiary? That was the question. So any other person, she have said her own view. Any other person, let's contribute to it.
Yes, depend on the time of the death and the time of submission of the application.
The application have already been submitted to the feed to the insurance company.
Okay.
Submission has been made.
Okay. Then the application goes first before the death.
Yes.
But approval has not happened.
So approval has not happened, but what we're asking is that the beneficiary gets that benefit from the policy.
50-50.
No, I believe 100%.
Yeah, or is what person say 50-50? You say 100%. Any other person? Any other person? Put your own view. How many of us here? I want everyone to contribute this because that's a wake-up call for all of us. Any other person? Maria said her own view yesterday, so I throw up that question again. Any other person? Edwin Chikere. Edwin, you have your contribution to it. And Nancy? Nancy, you have any contribution to that question? I think Sophia
Edwin is at work.
Oh, what of Teresa? Miss Teresa? Precious, I want everyone to use your minds, except you're at work. I think Sophia has said, Sophia, have you said something? I think, yeah.
Yesterday.
Sophia has said something. So any other person? All right. So somebody said 50-50. Yes, it's 50-50. It's not 100%. It's 50-50.
Oh, yeah?
It's yes and no. Yes, because remember, this person has written application, submit, pay his initial premium, and the policy has not been approved. And he died.
Okay.
Will the beneficiary get bed benefits? Yes and no. Yes.
Okay.
Yes, if the underwriter finally approves the person. Remember, every information has been submitted. Then assume that they require lab, and lab has been collected. Then they have to go through the lab. And if they go to the lab, everything is correct, and this person died. All right, assume the person did not die the same day. He died 2 days after or 1 week after. They have collected their lab. So will the benefit be paid? Yes and no. If they go through everything, they find out that this person is innocent. He doesn't have anything. He doesn't have any problem. No health issue. He's clean.
The dead just took him. He's
Yeah.
innocent.
Yeah. Yes, he's very innocent. So, so no any issue. They're gonna pay the benefits. So, and if they now find out that this person is uninsurable, they're not gonna pay the benefit. They will return the premium to the beneficiary.
Oh, wow.
Yeah, so
Yes.
everything boils down on their own end. You've done your own end. Then when they come back,
so
they can okay it.
What the thing is telling us now is everything about insurance is fast. Don't waste time. Yes, that is the education we are getting out of it. Is everything insurance is deals with time. Do not waste time. Do it immediately. Do not waste time. Do not say, let me take my time. Tomorrow, next tomorrow. No. Do it immediately. Because you may end up saving some families agony. Of course, nobody knows when he will die, when he or she will die. Nobody knows.
It's true.
So anything you are doing, when you begin write a policy, anything you are doing should be fast. Don't waste time. Do it immediately. So we have not talked premium paid with application. So they said the producer should who is the producer, the agent, the feed order should collect a premium from the applicant at the time of application or as early as possible thereafter. The premium is generally forwarded with the application to the underwriting department. If the applicant doesn't make the initial premium payment, when completing the application, the agent should still submit the policy application to the insurance company, even without the payment. That is without the initial premium. Say, even if a policy is approved and issued, it will not become effective until the initial premium is collected. So you submit the application without premium. Even if the approved application is not going to be effective until initial premium is collected. Remember, in the contract, what do you bring to the table? What is the consideration clause on your own side? The consideration clause is what? Remember who said
application and premium?
Application and premium, that's the consideration clause. Remember, if you submit the application without initial premium, have you completed their terms of the contract, their own set terms of the contract? No. So no contract there at all. So that is it. So the city say it will not become effective until initial premium is collected, of course, as an application that is submitted without initial premium is typically referred to as what? Trial application. The submit application without initial premium is called trial application. Remember that an applicant's consideration is one of the requirements for a valid contract. There must be an applicant consideration clause before a valid contract is being said to be happened. Remember the insuring clause, which is the consideration clause in part of the insurance company, is always there waiting for you to bring to your own consideration clause to make it a valid contract. So an insurer will not what allow an applicant to possess what a policy without receipt of the initial premium, of course. If they don't receive the initial premium, even if they approve the application, it cannot be, the policy is not issued. All right. I think premium receipt is exactly what we have said. You know, when you submit with the initial premium, they will give you what we call conditional receipt. So know that one, conditional receipt. So the conditional receipt, does it do what? Does it makes the policy binding? No.
No.
Until when the policy is approved. So that's what you know, conditional receipts. All right, we have talked about conditional receipt. We're not going to go through it again. All right, insurability. Type conditional receipt. Of course, everybody knows what we mean by insurability. From insurability, we talk about insurable interest. What is an insurable interest? Can anybody be able to define what insurable interest means? Insurable interest. What does it mean?
You have to have something to lose if that person dies.
Yeah, of course.
For you to be able to insure them.
All right. Yeah, for you to be able to write policy on that person, you must have insurable interest. What is insurable interest? You have insurable interest to anybody that's related to you, that if anything happened to that person, you must have a financial loss or otherwise. That means you have insurable interest to that person. Means you cannot put policy for a stranger you do not know. It's against the law.
Oh, baby.
So anybody.
Baby, okay?
Meet your stuff. Meet your distance.
Yeah, I moved him already. All right. So that is insurability type conditional receipt. Of course, everybody know conditional receipt. When do we have conditional receipt? Anybody? When do we have conditional receipt?
Then when you pay your premium, they give you conditional receipt.
When you pay your initial premium, submit you're paying your premium, initial premium with the application. Yeah, which means you're submitting application with the initial premium. The agent will give you what we call conditional receipt. So please know that. So the conditional receipt is just to tell you that, look, you have paid your premium, initial premium, and your policy has been submitted. That's basically what it is. So insurability type and conditional receipt. Say the insurability type conditional receipt states that the insurance carrier has made an offer of coverage, but the offer is conditional. So they give you conditional receipt. What does it show? It shows that you have made offer to the coverage, but the offer is conditional. That's why it's conditional receipt. What's the conditional? What made it conditional? Because the offer becomes accepted and approved. Again, when there's a counter offer and return of you sign a return receipt and all the rest, it becomes a binding contract. So all right. Where do you go? All right, coverage becomes effective on the date of the application or the date of any required exam, a medical exam, whichever is later. You know, remember we said if you submit an application with the initial premium and there's a lab indicated, if that lab is given, that lab is collected and tested, and all is negative, you're good.
Good to go.
You're good to go. So whether the person die or not, they're going to pay the benefit. They don't have choice. Even though they're going to they'll still find a way, but still yet you stand a very good chance to get your benefit. So coverage becomes effective on date of the application. Of course, that we have said it before. When you do conditional receipt, the coverage becomes effective on date of the application. So if the exam refer the conditional receipt with no further application, assume it is insurability type conditional receipt. So we said it becomes conditional until when the lab proves otherwise. All right. approval type conditional receipts. It's sort of the same thing we said, just when there's a lab, you give a conditional receipt, then they become approval. That's it. Nobody gonna ask you that question. Let's look at binding receipts. Of course, this is the one that confuses from the conditional receipt. You want to be able to differentiate between the two, the binding receipt and the conditional receipt. However, does anybody have a binding receipt nowadays? Most insurance companies do not want to do that because there's a very high risk you're giving somebody a binding receipt. If, let's assume, in the place of conditional receipt, an agent give you a binding receipt. Binding receipt means that the policy has already become effective. It's binding. The two condition has been fulfilled. Insurance clause and the constitution clause has been met, so it becomes binding. Agreement has reached, it becomes binding. Let's assume you write a policy for somebody and you submit to the underwriter, you give that person binding receipt. Means that that policy has started effectively, whether underwriting has gone through it or not. So most insurance companies do not want to give a binding receipt because it can result to a loss to them. So the binding receipt may also be referred to as a temporary insurance agreement or even conditional receipt, unconditional receipt. You see, it's temporary insurance agreement.
Jesus.
So you give somebody a binding receipt, means that you're already giving that person policy, but it's temporary. So if you give that person binding receipt and say it's temporary, which means if anything happens, that person is covered. You don't need to even to investigate because the person already having a policy. Investigating means that you want to satisfy your mind that, look, nothing bad happens. It's good. But the insurance company do not want to do that nowadays. It's very risky. So it's under the terms of binding receipt, coverage is guaranteed until the insurer formally rejects the application. Did you guys see that? So binding receipt is bad. If you give a binding receipt, it's guaranteed that what the insurer has formally has
Approve the policy.
approved until accept rejected. So that waiting period, the person get to wait until the policy is approved by the insurance company. You don't need to have that because you already have a policy. So do you think any insurance company go for binding receipt? No, of course. So even if the proposed insured is ultimately found to be uninsurable, the receipt still guarantees coverage until the application is rejected. So you give a binding receipt to somebody, already giving him a short policy. Therefore, the insurer must pay the claim if the applicant dies before the insurance company formally approves or rejects the consumer's insurance application. So this one now is no longer conditional, it's binding because whether you approve or not, you pay. Except you finally reject it. If you reject it, then it becomes ineffective. So I don't think any insurance company wants it to obey. As with the conditional receipt, a binding receipt typically do what? Stipulate a maximum amount that's payable during the particular protection period. Binding receipts are far more common for auto or home owners insurance. So they use binding receipts on auto and homeowners insurance. Nobody will use binding receipts in life insurance. It's delicate. If they do like that, a lot of people are making money, I tell you. All right, I think we're gonna. I thought we were gonna finish. All right, temporary insurance agreement. What type of insurance is temporary insurance? What type of insurance is temporary insurance? Anybody? What type of insurance is temporary insurance?
I've never heard about this one. No.
Temporary insurance. Who can remember by your own knowledge?
For flight, if you buy a flight ticket.
Yeah, that's a temporary insurance.
Case if you don't make it down.
No, you make it down. You make it down. You see why it's called temporary? Immediately you step inside that plane, It's effective. If you step out of the plane, it's gone. That is it. If you step into the plane, it's effective. You step out, it's gone. You no longer have policy. However, remember the plane has insurance covered of the plane and every other person on board. You know that? So that's why when people die of plane crash, the families always go for claim because the plane have really provided a limited insurance policy for everybody on board. Yeah. So you now get
really. So you don't have to buy it separately.
It's just waste of time, waste of money.
So when we pay, it's included.
The plane already have a policy for everybody.
Oh, really?
Yeah.
But why do they ask for this one?
If you look well, any day you are buying flight, look well. That question is by the side. It's just any day you are buying flight, look well. It's not with the website. It's by the side. It's by the side. It's not the website that have it. Yes. So of course, I remember one of the rules of money is that make money. Rule number one is what? Make money and don't lose money.
Lose money.
What is rule number two? Never forget rule number one.
Rule number one.
So now you see ahead account whether is worth investing or not worth investing. However, if you most often when you buy flight you do not buy flight on the website, you may decide to put policy. Or if you buy with website, since all of us sleep and eat with insurance, you can decide to buy it too. It's not a waste. Insurance is insurance. Insurance is very important. Nobody discourages that. Yeah. But however, make money and never lose money. Rule number one. Always follow rule and rule number two. Also follow the two rules. So temporary insurance agreement is similar to a binding receipt. In fact, some jurisdiction, the two terms are used interchangeably. In contrast to binding receipt, the agreement provides only a limited amount of additional protection. Temporary insurance provide what? A limited amount of additional protection. Did you see it? Did you see it?
Yeah.
To provide what? A limited amount of additional protection. So in a flight, you already have protection. However, like a binding receipt, the temporary agreement provides immediate coverage. Coverage remains in effect during the entire underwriting period. If the insured dies during the underwriting period, the claim will be paid. The insurer has the right to cancel coverage if the application is ultimately denied by the underwriting. This one, just know about the binding receipt. That's what you need to know. Don't stress yourself. I'll distinguish between conditional and binding receipts. Understand the following difference is essential for success in your exam. So let's be able to differentiate between binding receipt and conditional receipt. A conditional receipt provides coverage only if subsequent underwriting confirms insurability based on the application date or medical exam date. That is conditional receipt. That's what we know about conditional receipt. Then a binding receipt grants what? Immediate coverage until the insurer makes a final decision. So if you're an insurance company, will you give a binding receipt? No, because it grants immediate coverage until the insurer either approve or deny the policy. So it grants immediate coverage until the insurer what makes a final decision based on either approving or denying the policy. So it can't just write application, submit, you give him immediate coverage, waiting until when you decide. I don't think it's wise. It's not wise. It's not economically. It's not wise to the insurance company. So I said something before about offer and counter offer. Who makes the offer? You. You make the offer to the insurance company. Who makes the counter offer? The insurance company makes the counter offer. So I think that's what you get to know. So when the applicant completes the application and pays the first full premium, they are making a legal offer to the insurer. The applicant makes the first offer by what? Filling the application and paying the initial premium. It makes what? A legal offer to the insurer, which is the insurance company. If the insurer issues a policy as requested, the insurer accepts the offer. That is, when the insurer now decides to issue the policy, it accepts the offer. And the
That is
contract,
counter offer.
that is a counter offer. And what? A contract is in force. However, if the insurer, that is not a counter offer, hold on. However, if the insurer declines the application, the offer has been rejected. Now, for a legal standpoint, what happens if the insurance company is willing to insure the applicant, but only on a rated? What's the rated risk? Substandard. Remember, when you see a rated risk, is the same thing as substandard form, which will naturally require a higher premium. In this case, the insurer rejects the initial offer and makes a counter offer.
Okay, that is the counter offer.
Counter offer. Remember, I think counter offer comes in when the insurer, when you are filling the form at the first initial design of the policy, the agent will give you a rating. Now, the insurance company go ahead and look the underwriter go ahead and look at the application, see that no, this rating preferred, which the agent is not what it is. I'm going to give a standard rating. Now, they will now give that standard rating and make a counter offer to you.
Okay.
You accepting it means that you are signing the delivery receipt and the statement of good health. That shows that you have accepted it, and now the policy becomes binding. Is that okay? I hope everyone knows. So we're gonna move ahead. All right, let's do this one. I think that will remind you end premium mode, and policy fee. So let's start with, it said the frequency of premium payment, annually, monthly, etc. is called what? What is it? Frequency of premium payment, what is it? Frequency of premium payment, what is it called? Remember I said you can pay annually, monthly, or semi-annually, or quarterly.
Mode of payment.
All right, we'll set mode of payment. So let's go to mode of payment. Let's take short mode of payment. Listen, it can be.
No, it wouldn't take it. Oh, Lordy.
It will take, let me see. It's always, all right, text it, all right. That's premium mode. Now, the second one said the portion of premium for coverage already provided. The portion of premium for coverage already provided. We said this one with a lot of demonstration. The portion of premium for coverage already provided. What is it called?
Is it earned premium?
Earned premium.
I'm guessing no.
No, don't guess.
I guess the same thing too.
There's no need to guess. This kind of thing, you have to say what it is, because in the exam, and in the exam, you have to say, you don't need to guess. So this one said a transaction fee charged in addition to the regular premium is what's called what?
Premium fee.
All right.
Fee.
I hope it's not guessing.
Policy fee.
It's not guessing, I think.
We are guessing.
This one said premium that must be refunded if the policy is cancelled is called what?
I guess so.
We can put this one here.
Okay, we can put it there, but
yeah, premium.
That's what it is.
Hold on, we are counting.
We made it.
We made it.
Clap hand for us.
Premium. I remember when I used your bill to give example. The one that will return to you if you decide to cancel is what we call earned premium. The one they have eaten is called earned premium. Yeah.
Wow.
Oh, it makes sense now.
Yeah. So community rating means that premiums are based on individual specific health history and risk factors, true or false? Community rating.
Community rating means that premium are based on individual specified health.
History and
I think it's
history.
true. I think it's true.
Community rating means that premium are based on a individual specific health history and risk factors. The correct answer is false because community rating are the same premium structure for everyone in a defined community. That's why we use what? Is it small group or larger group? Small group. So the approach spreads risk across the entire community rather than changing the higher risk individuals more, which is what it is. So it's false, not true. All right. Policy issue and delivery. I think we're gonna start. This you see, I think we're gonna do it tomorrow again. Probably gonna do it a lot of tomorrow and next. I mean, morning and evening before we can finish it off. It's a long chapter, and believe me, this chapter is all that is half 1/4 of what you need to pass. That's the basic truth. Because you can see what we are doing here. What we are doing here is basically what you would do as an agent. That's exactly what we are doing here. So if you do this chapter 19 and do chapter 1, 2, 3, I think you'll be good. Do annuity, you'll be fine. I'm telling you. So we're gonna stop here. We start tomorrow morning with policy issue and delivery. Because if we start this one, it's gonna take us till 9 o'clock or 10 o'clock. And with the intensity and it somehow looks boring. Everybody's getting tired.
Yes, Professor Bart.
Any question?
Oh, just me. I need to ask you. You see that little thing that you have playing at the beginning of the class? That little is that on YouTube?
Yeah, it's just the definition terms. It's on the YouTube.
Oh, what's the name of it?
I don't even know the name. I just see it. I was playing it. All right, hold on. Let me see.
That one is very good.
Hold on, let me. It's just the definition, term definition. Let me see whether I can get it.
The one you play it every morning.
Yeah, I just play it to keep everybody in
awake.
Yeah. Right, hold on. I'm gonna get it. Let me. Oh my God. Did I cancel everybody? Yeah. Hold on. Upright.
It seems so.
Where? Lakeview? Where is Lakeview? Send me the address.
Me?
All right. Send me the address. I'm coming. All right. What I'm gonna do, I'm gonna post I'm gonna put it on the chat.
Yeah.
So that everybody can.
Right.
So that everybody can copy it. If you want to listen to it, it's just about
just a listen.
Yeah,
It's very good, man.
you can copy it from the chat. It's just about life insurance vocabulary. You can listen. Yeah, it's life insurance vocabulary. You can listen to it. I like to play it. It's good for everybody. Just listen to it and that's it. All right. So copy it from the chat. Everybody, if you want to just copy from the chat, you can listen to it on your own free time. It's just to tell you the life insurance vocabulary you need to know to pass the exam. Yeah. Right. So I think that's what we're going to end today.
Engineer, I have a question.
Go ahead.
The other, is there another group for, another class for people that pass their license? You used to say, they're going to join the other side. Is there another group for
I think we use Which one, Miss Sophia, which one do you, we have two groups here.
And I'm in collab.
Oh, you're in collab. Oh, collab is quite different. Collab is
general.
Collab is for the whole hierarchy.
Okay. Yeah, if there's another group where, you know, one can be trained, you know, knowledge is
where you
not
can
so.
get more knowledge?
Yes, sir.
All right, all right. I think is it for the licensing?
No. I pass, you know, for the business, you know. Business.
All right. You can be. What happened that most of the time they're doing training. Let me see. There's training now. You can log in and. But most of the training will not make sense. Most of the training will not make sense to you now, except what we go in is BPM. Attend BPM. That's good. What you can benefit from now. But most of the training, inside training, in fact, you confuse.
No, sir. No, sir. That's what I need. That's what I need. Remember, I told you that I'm here because of my husband. I want to encourage him to take the test. I passed my license already, but I'm here because of him.
What you need to do is to introduce me to your husband. I can take care of that. We can be talking.
He introduced himself yesterday.
He introduced himself yesterday.
But I wasn't there. I just.
You have told me.
I brought him in.
Anytime he's in, just introduce him to me. I can now talk to him.
He's here. Let me see if he left, but he's at work anyway. He joined from work.
Yeah, you see, that's you see our men. I think I told my story yesterday. He might have
he's here, but he's at work.
Yeah. All right. He might have listened to it. See, let me tell you, our people, I don't know. Because you know we know a lot.
Yeah,
I don't know how to say it. We know a lot. Because we know a lot, we take things for granted. Believe me, there's no need to working all those money, suffering all those things, and you end up going to nursing home. Whether you like it or not.
I wish I had known you guys.
See, whether you like it or not, that's where it will end. Because look, let me tell you, the 401k you believe on may not be there. Even if it's there, the amount you're gonna collect when you retire may not be enough. The Social Security is dying.
Yes.
So if you now get all this knowledge, you can now redesign yourself. How do I focus? How can I be able to do one or two things? It's a general knowledge that benefits everybody. But one thing is that our Nigeria community, maybe you're from Nigeria, I'm sorry to say that for Nigeria people. Our Nigerian community, we are so hard-hearted. That's why most of us not go church, because we are so hard-hearted. We believe that everything is cheating. That's the truth. And we so much believe in man is the supreme leader.
Jenny Lights.
You know, that's our problem.
If you mute.
Somebody
sorry.
Yeah. So we believe that the man is a supreme leader. No. I'm a man. I'm sorry to say that. But we believe that our mindset is focused that I'm the authority, you know, because I'm authority, everything I say is the final. See, if you look at it critically, until you get this thing, it not mean that a wife will not love a husband or husband will not love a wife. Agreed. Yes. But we have to be sincere to the terrain that we're into. We have to understand, he said, if you go to Rome, behave and do what the Romans do. Now that we are here, we understand their financial strategy. We should be able to adopt it to survive. Or otherwise, if you follow otherwise, by our culture and what we see others are doing, which have not helped, then we're going to fail as they have already failed. So this issue is not just like if you tell a husband and wife now, some husband, immediately they get paycheck, they go and dump it somewhere. Is that intelligent? No. You carry all the money in the whole house, put it somewhere, because you want to see what the wife is making. You want to see what the husband is making. To me, that looks stupid. Because we don't understand. Nobody is sure of what will happen tomorrow. Nobody is sure of what's happening in the next second. Nobody's sure. So if that is the case, if we know from God that that's how God designed it, then why must we do a plan that's focused on ending one day? Why? So except you begin to understand don't get me wrong. I have the same idea before I get liberated.
Yeah.
No, that is the truth. Until you listen, until you believe, you cannot be liberated.
Mm.
I have the same idea that, oh, husband and wife to show much love, let's put our money in the same account. That's the idea we have, all of us have. And get me wrong, some families are fighting today because of that. Because they want to put money in one kind. They're forgetting that anything can hit them. If anything hits, the whole money goes to the probate. The person remaining and the children will suffer. So all these ideas we have to begin to remove from our people so that they can focus and do the right thing. Yes, it's beyond love, it's beyond marriage, it's beyond things around us. We should do the right thing and set everybody free.
CD. You know about CD?
CD, yeah, you can do CD. CD is if you do CD, if you compare it to what you get in doing life insurance, you cannot compare two of them. Because what life insurance give you protection and give you element of although we say life insurance is an investment, but if you look at it, there's element of accumulation that is in the idea. So if you do CD, you're only doing CD to receive interest. But remember, if you do life insurance, you are not only receiving interest, but you are giving yourself a protection in case if anything happened today. So that is the difference. So the money you can use to put in CD, why not go and put it in life insurance? That will work better and give you a better protection.
Besides, it gives less than 6%.
And besides, CD gives less than 6%. So given the percentage they're giving to me is not even relevant. What matters is what protection do I get from CD? So it's a problem of knowledge. So until we begin to tell it to our men, they understand. Until we begin to tell it to everybody, everyone will understand. You see, people, if they find the wife, they don't see the wife, the whole family crush. If they find the husband, they don't see the husband, the whole family crush. So until we begin to tell ourselves that, you pack your money, put on 401k where you're working before. Why you still keep it there? Because you lack knowledge. You want to put your money where you'll be seeing it because you lack knowledge. Why not carry that money, put in a portfolio where you only participate in the gain and not in the loss? Why do you want to keep your money where you participate in the loss and in the gain? Remove it from loss and put it in gain. So all this thing is, except you participate on all this kind of teaching and you go on the platform and you begin to learn, that's the only way you can benefit. For you, they may not like we cannot put you now. Since you pass your license, you can be in the platform where you learn. You have your license already. So
that's what I want, sir.
Yeah. So who is your
professor?
Who bring you to the business, you know?
She need to go into
the lady is not the lady, like, she dropped out somehow.
Oh, so
and I'm on a loan.
Oh, are you under who? No, you can't be alone.
Okay, where I am, right?
Uh-huh.
The person that brought me is all the way in I think she has moved to Dallas also.
No, even if you move to New York, what's the name of the person?
Juliet, but she's no longer. She kind of dropped off.
All right, so
one thing or the other,
Have you? All right, can you speak to Dr. Ruth?
Yes, I can.
All right, you know her number?
Yes, I have her number. Yes,
it's 469 487 3469. 469 487 3469.
3469.
So I will tell her that Miss
Sophia
will call her.
Or Chinenye.
All right, I'll let her know because so you can speak with her. Nobody drops out. It's not, most people that drop out is people who don't have faith in what they're doing. And most people that drop out, see that wherever they go, it's with the same problem. So I told her that Sophia will call her. So you call her and speak with her. She can bring you up to the training department since you have passed your license, or I can even help you to direct you on how to start the business well.
That's just what I need.
Yeah. Then you don't belong here if so.
No, like I said,
you don't belong here.
I directed my husband. So once he stabilized, I will leave.
Yeah. So what you do?
Oh no, you know what?
Huh?
You are teaching both for the exam and knowledge.
Yeah, I'm teaching both.
I love to listen to you because when I did the exam, I just did it just to pass the exam, right?
Yeah.
But the way you explain these things, right? It made me to now start understanding it deeper, to be honest.
Yeah, if you go to the teaching class too, you understand it far better.
More.
Yeah. If you go to the teaching class, like now there's training going on now. But if you are not licensed, you're not gonna put you on that platform where you can go directly and learn.
Put me, I'm licensed. Put me.
Yeah, that's what I'm saying. Speak with Dr. Ruth. I'm gonna tell her that you call her. What's your number? What's your number?
786 322 0276.
All right. Call her. She's on training now. Call her in the next 1 or 2 hours.
Okay.
She's on training now. I'm probably gonna talk to her. I'm gonna talk to her about you. So she can put you where you belong, and that will help you. For your husband, you are doing what you can do as a woman to make sure that he is here. If I know that he is here, I'll talk to him face to face. I'll tell him what he will listen to. I'm a man like him, which means I'm not gonna lie to him. I'm gonna tell him the real truth, nothing but the truth. So I need to see him. If he's listening to me, we need to have a one-on-one, man-on-man chats.
Okay.
Yes. So that's what you need. If you need to do that, then what you'll be doing is to remind him. So, have you entered class? Today is now teaching. That's what you're doing. Not to enter here where you belong, except you just want to listen to us. You can. But if not, where you get the real training is some other place. It's not here.
Yes.
All right. So see everybody tomorrow morning by 8:30 in the morning. All right. Good night, everybody.
Good night.